This meeting is being recorded.
All right, welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to be with all of you here in the fourth week of our fall 2024 semester here at UDC. We have made it to the fourth week already, and for those of you who are really interested in math, that means that we are 1/4 of the way through the semester. It's interesting when we say it that way, right? We're a quarter of the way done with the semester already. Yeah, I know it goes by so fast, doesn't it? So that means we are going to be covering chapter 4 today. Before we jump into the conversation on the accounting cycle, I want to quickly point out a couple of things in the classroom. So I'm going to share the classroom screen now, and here we are on the home page of the classroom. All of you are doing very well in the course so far, so I wanted to say that, and I also wanted to say kudos to you for really trying and sticking in there. Just as a reminder, if whatever reason you don't do as well as you had hoped on a quiz, uh, please feel free to go back to that quiz because you have 2 attempts on every quiz to try to earn a higher grade. Now, there's a couple of recommendations I have for you as you're taking the quiz and also studying for it. My recommendation is when you go to the week, let's say it's week 4 that you're going to take the quiz on. I always recommend that you have the PowerPoint presentation open along with your textbook in different tabs. Reason for that is because oftentimes the quiz will ask a question that is related to what we covered in the PowerPoint presentation. And so having those open in maybe a separate tab or you download them and have them open at the same time, I strongly recommend that you do that because you'll find that it's very helpful as you're going through the exam or the quiz. So that's my recommendation to you. So how you get to the PowerPoint presentations is you go to the respective week and you go to the instructional materials, click on instructional materials, and your PowerPoint presentation will be here. And so I strongly encourage you to download them or to at least have them open as you're taking the quiz because it's certainly going to be helpful for you. The other thing I recommend that you do to be successful on any quiz is, of course, to look through the book as well. So if you go up to the start here and you come down to the textbook, Brightwave course materials, and when the textbook opens, and all of this has been fixed, by the way, I want you to open the book and have that open on a separate tab as well. I find it to be helpful. The other thing that along those lines with when it comes to studying for any type of quiz or exam is the book has a bunch of practice problems and flashcards and really good material like that. So I would encourage you to maybe look through it. I think you'll find it helpful. The best way to navigate is this little button up here on the right side, the table of contents. And then, for example, we're going to jump into chapter 4, which is the accounting cycle. So it's, as you can see, it's broken up a little bit different. It's broken up a little bit in more detail, in my opinion. But we're going to be going through the accounting cycle, which should be somewhere about here. There it is. So page 138 of the text. This particular, because you'll notice that the content of the textbook is broken out by topic. Toward the end of each area, you'll notice that there's going to be some like sample problems, etc. And I kind of like these ones here because you can kind of observe how to solve some of these types of problems. Uh, and working through the exercises, especially the need to know type ones, it's helpful. It's very helpful. And then, of course, as you come down, you can see the solutions. And so try to work through some of these examples and practice problems because you'll find that they're very related to the quizzes and exams. The other thing I like most is the flashcards. I think that this is really helpful as well. So just kind of explore through the tools that come with the book because you'll find that they're really, really helpful. So that's my recommendation. Have the textbook open, have the PowerPoint presentation open as you're completing the quiz. So that is my recommendation for success on quizzes. So here we are in week 4. We're about to cover the accounting cycle. A couple. So instructional materials where you find the PowerPoint presentation and you can follow along there. And so for this week, related to today's discussion, we have some very important things to get through for this week. So we have our next LinkedIn Learning Certificate. All of you did very well with the first one that we had, and I think that was on Excel, if I'm not mistaken. Something along those lines. I think it was Excel. We had that one. It was probably 3 weeks ago already. So this is our next one, and it's on Financial Accounting Part 1 is the name of the LinkedIn Learning Certificate for this week. It's very similar to the one that we did before. So what you'll need to do, and this is only under the Engage and Explore is the one that you need to look at. These other videos up here, don't worry about these ones. These are just for informational purposes. These are not related to the LinkedIn Learning Certificate. Okay, so what I'm saying is that under instructional materials, those are only just for instructional materials. They're not related to the LinkedIn Learning Certificate. The LinkedIn Learning Certificate is going to be under the Engage and Explore folder. And for this week, you have to do the Financial Accounting Part 1 LinkedIn Learning Certificate. And the way it'll work is just like before, you'll open it up and you have to go through the series of videos. And there are quite a few of them. This will probably take you, if I had to guess, probably about an hour and a half or so to complete. So take your time with it. Make sure you're consuming as much of the information as possible. And as each video is covered, you'll know that it's covered by the green check mark that'll appear to the left of the title of that video. Once you have green check marks next to all of them, and you make it all the way to the end, and including the next steps, that'll also turn green with a check mark. Then your certificate will either pop up. Make sure you enable your pop-ups, by the way. And then, or you can select the one that says certificates, click on the show all, and you'll select the LinkedIn Learning Certificate. And you'll want to download the PDF copy. And if you want, you could also share it with your LinkedIn profile and network, which I usually recommend that you do that. Why do I recommend this? Because employers love seeing certificates, and it's helpful. Now, you might say, Dr. B, I'm not going to be an accountant. My employers don't need to know this. Yes, they do. Here's why. Accounting, as you know, is in every single business. This isn't not just related to becoming an accountant. Okay? This is related to every job that you might apply for. So it's very, very applicable, is what I'm saying. So I recommend that you also post this to your LinkedIn account. Just my recommendation, yes. But you want to download the PDF either way, and then you'll come back to the classroom and you'll upload it right here to the one that says Financial Accounting Part 1 Certificate. You'll upload the certificate here, you'll click Submit, and then when I get to it, I'll grade it, okay? So please, I recommend you do this one early. Why I recommend early, because again, it takes an hour and a half or so to get through. So your class time on Thursday that I always reserve for you to do the coursework, please do this on Thursday, because I promise you it'll take away any stress that you might experience on Sunday night. Okay? Because I know, I remember what it was like to be a student. I was like a lot of you. I used to procrastinate also. But I promise, procrastination is not good, right? So please, I recommend that you complete the LinkedIn Learning Certificate on Thursday, because it'll help you in your week, to help plan your week out. Because I get anxiety if I wait to the last minute on things, because I'm like, oh, I'm scrambling, 11 o'clock at night on Sunday, and it gets rough. So to make your life easy, I recommend you do LinkedIn Learning Certificate on Thursday. Okay, and then you'll take the Chapter 4 quiz. So that's this week. Now let's go ahead and jump into the lecture for today, which is completing the accounting cycle. And we'll talk about this from the perspective of what we were going to cover last week. And I'm hoping that you watched the recordings of the lectures from last week, the recording of the lecture from last week, because this chapter is directly related to what we talked about last week. Yeah. So let's jump into it. So completing the accounting cycle. Last week, we did adjusting entries. And so the lecture recording went over the types of adjusting entries that we would make and why we make them. When we complete the accounting cycle, we take into consideration the adjusting entries that we did last week. And the reason for this is because the adjusting entries that you prepared last week, those help to create what we call the adjusted trial balance. Okay, the trial balance helps us to understand that our balances are correct for each account. So the accounting cycle, we started with identifying the transactions. We posted the transactions. We did the T accounts. And then we went through that process. Then we did the adjusting entries. And then we did the trial balance. And now, from the trial balance, we were able to create the financial statements, income statement, balance sheet statement, the cash flow statement, the retained earnings. We're able to create those from the trial balance. See, on adjusted trial balance, we did the adjusting entries, we got the trial balance. From the trial balance, we create the financial statements. That, in essence, is the accounting cycle. But we're not quite done yet. Once we've prepared the financial statements, income statement, balance sheet statement, cash flow statement, and retained earnings, at the end of each month we do this. Then we need to close our temporary accounts, which are all of our income statement accounts, right? Because we can't start September with balances already on our income statement. The income statement needs to be closed every month. And we do that through a closing process, closing entries. And I'm going to show you what all that looks like today. But if you think about it logically, I didn't start September 1 with balances on my income or expenses for September. The month just started, right? I don't have income already on September 1. I don't have expenses for September. The month just started. Okay, I only have a few expenses like rent, but that's it, right? The month just started. So we need to close out at the end of each month. We need to close out the month so we can start the next month fresh with zero balances on our income statement. And there's a process to do that, and I'm going to show you what that looks like today. One thing that accountants might use is this thing called a worksheet. It's like an Excel spreadsheet, okay? It's a worksheet, and it helps us to prepare the financial statements. It's not required. This is not a required step of the process, of the accounting cycle process, but it's helpful. So what it does is it helps us to reduce errors. It helps us to prepare the financial statements, helps us to identify the linkages between the adjusting entries that we made from last week and the financial statements. And it also helps us to show us the effect of the transactions. That's why we might use a worksheet, an Excel worksheet to help us in the accounting cycle process. Again, it's not a required step of the process, but it is very helpful to do. So there's 5 steps to help us in creating a worksheet. The first step is we enter the unadjusted trial balances. These are the balances of our accounts before any adjusting entries. Okay. Unadjusted trial balance are the balances of all of our accounts before we make any adjusting entries. The second step is to make the adjusting entries. You learned about those last week, right? How to make adjusting entries. Example of an adjusting entry. We have prepaid insurance. I gave the example of insurance a few times throughout the past few weeks. In business, we typically, and in the household, we typically pay our whole year or 2 years of insurance up front, okay? And that payment, that might be somewhere in the middle of the year. Okay, for example, for my personal insurance, I pay my insurance for the year on March 1st every single year. Now you might be wondering, because that's when my policy starts, March 1. Okay? It doesn't always follow a regular calendar cycle. You know this. It just happens to start on March 1. If you think about that, if my policy started March 1, at the end of the calendar year, I need to make an adjusting entry for this insurance. In fact, I should be making adjusting entries every month. But if I don't do that, I need to at least do it at the end of the year. Why? Because I prepaid the whole year on March 1. I prepaid 12 months on March 1. On December 31, only, how many months? 10 months went by? 9 months went by? So I got March, April, May, June, July, August, September, October, November, December, 10 months. I got 10 months of insurance that I used, that I consumed, right? Policy started March 1. On December 31, I need to make an adjusting entry to recognize the consumption, the use of the prepaid insurance. I should be doing it at the end of each month, right? Because that's how I recognize insurance expense on my income statement. But if I don't do it that way, I at least need to do it at the end of the year. Okay, so the way I would do that is I would debit insurance expense and credit prepaid insurance. Remember the matching principle. The matching principle tells us that we need to recognize revenue and expenses when they were incurred, okay, when they happened, right? That's what the matching principle tells us. It matches the revenue earned with the expenses that were incurred to earn that revenue. That's the matching principle. So every month I should have been making that adjusting entry. You see? So that's just one example of adjusting entries that we went through last week. So step 2 is we make the adjusting entries on the worksheet. The third step is we prepare our adjusted trial balance. The way that we do that is we take our unadjusted trial balance amount for each account, plus or minus the adjusting entry amount to get the adjusted trial balance amount. You see? I'll show you what that looks like, don't worry. Step 4, we sort the adjusted trial balance amounts to the based off of the financial statements. And step 5, the total statement columns compute the income or loss and the balance columns. Don't worry too much about those last 2 steps. They're relatively automatic. But I want to show you what it looks like. So this is an example of a worksheet that we just talked about. The first step is to prepare the unadjusted trial balance. You can see that in the green area, we have the account names, and then right next to the account names, we have adjusted trial balance. Notice the accounts listed out. At the top, we start with cash. Why? Because it's the balance sheet starting with cash. Every balance sheet in the world starts with cash. Why? Because cash is the most liquid. It's organized in the order of liquidity. Cash, accounts receivable, supplies or inventory, prepaid insurance, equipment, and then we have depreciation on the equipment. And then we go, those are our assets, and then we roll on to our liabilities. We got accounts payable, salaries payable, unearned revenue. And then we move into our equity, paid in capital, owner's withdrawals, revenue. And then we see all of our expenses. Okay, we see the revenue and then we see the expenses. That, of course, is coming from our income statement. And then we get our total and then net income. So, first thing we do, prepare the unadjusted trial balance. Those amounts come from the balances for the year. Okay, the balances of those accounts for the year. Easy peasy for the month. Then we make the adjusting entry. We make the adjusting entries at the end of each month. Should be doing it at the end of each month. So here we have a couple of adjusting entries that we made. We made an adjusting entry to the accounts receivable, to our inventory, to our insurance, so forth and so on. So we make the adjusting entries. You can see the matching. So transaction A was adjusting entry for $100. We adjusted insurance expense and prepaid insurance. Why? Because we consumed $100 of insurance for 1 month. Yeah. So we debit insurance expense, credit prepaid insurance. Second transaction was for $1,050, and that was for the use of inventory. We debited $1,050 inventory supplies expense and credited supplies. Transaction C, or 3, we recognized the depreciation on our equipment. We debited depreciation expense and credited accumulated depreciation. Transaction 4, it looks like we recognized some revenue that we earned. So we debit unearned revenue to reduce our unearned revenue liability and credit revenue to recognize the revenue. Transaction E, we accrued some, it looks like, let's see here, salaries expense for our employees for the amount of, let's see, $210. So we debit salaries expense, credit salaries payable. Okay, and the last transaction was for account receivable. We received, we sold consulting revenue on account. So we debited account receivable and credit consulting revenue. So those were our adjusting entries. So on the second area, we have adjustments, and we have our adjusting entries that we made. On the debit and credit side, we see that they're equal, so they're correct. The third step is to prepare the adjusted trial balance. And so here we see in the bluish gray color column, adjusted trial balance, we see the balances after the adjustments have been made. So for cash, there were no adjustments to cash. We never really adjust anything with cash, ever. Adjusting entries never really affect cash at all, okay? So here the balance remained the same, $42.75. We made an adjustment to account receivable, $1,800. We adjusted supplies, and you can see what's going on with the balances, right? They're adjusting based off of the adjusting entries, and that's why we call it adjusted trial. Or minus the balance, right? So that's why you see the totals changing in both the debit and credit columns for adjusted trial balance. Okay, and then from there, after we've made the adjusted trial balance, we prepare the financial statements. So step 4 is we prepare the financial statements. Income statement, you can see the totals there on the bottom. Credit the revenue and debit all of the expenses. On the balance sheet and the statement of owner's equity, we know the balance sheet is going to be all of your assets, liability, and equity accounts. And then the owner's equity is withdrawals. And so now my balance, my financial statements are prepared based off of this worksheet. Again, the worksheet is not a required step of the accounting cycle, but it is extremely helpful for accountants to make sure that there are no errors were made in the process. So based off of my worksheet, I can now go through the post-closing process. What I had mentioned earlier was we start each month with a zero balance on our income and our expenses. And so how do we get that to happen is the question here. We go through what's called the post-closing trial balance. We prepare closing entries, okay? And so at the end of each month, we prepare the closing entries to get our temporary accounts, which are our income statement accounts, to go back to zero, So I'm going to show you how to do this. So the first thing we need to do is we identify the accounts we need to close. We only close what we call temporary accounts. A temporary account are all of your revenue and expense accounts. The owner's withdrawals on the statement of owner's equity. And an account, we close them all to what we call income summary. Income summary is an account that we use temporarily to close our revenue, expenses, and owner's withdrawals. That account balance then gets transferred to the net income, which of course is going to be on a part of your balance sheet, right? Under owner's equity. So I'm going to show you how it works. The second step, after we've identified our revenue, expenses, owner's withdrawals, and income summary accounts, we record and post the closing entries. To do this, typically what we do is it's the opposite of what we would normally do to close them out. So, for example, as you know, to record an expense, we debit the expense account, right? That's how we record the expense. In order to close out our expense accounts, we're going to debit income summary for the total and credit all of the expense accounts. Basically what I'm doing is I'm resetting them. And I'm moving those balances to income summary. We do the same thing for revenue. For revenue, as you know, to recognize revenue, we credit our revenue accounts. In order to close our revenue accounts, we are going to debit our revenue accounts and credit income summary to close out our revenue to income summary. And this, of course, the same process for owner's withdrawals. So we're going to record and post a closing entry. And then once all of that is done, we will prepare the post-closing trial balance. This basically makes sure that our temporary accounts are zeroed out and our permanent accounts are updated accordingly. So as I had mentioned, temporary accounts are, as the name implies, temporary. At the end of each month, we close all of our temporary accounts. Why? Because we can't start a new month with balances already in revenue and expenses. You can't do it, right? It doesn't make sense. Because remember the matching principle. The matching principle tells us that we need to recognize the revenue and expenses when they are incurred. And so therefore, at the end of August, what I did was I created what's called closing entries in order to start September 1 with zero balance on revenue and expenses. So to close them out in August, I did what I had told you. I said I'm going to debit income summary, credit all of my expenses. I'm going to debit revenue and credit income summary in order to close those accounts, you see. When that happens, after that's done, I'm going to close out my income summary balance to my net income, which of course, as you know, goes under equity. So our permanent accounts are the account balances that do not change at the end of each month, or I'm sorry, do not get closed out at the end of each month. Permanent accounts do not get closed out at the end of each month. They will always be there. Your assets will always have balances through all of time, right? You're always going to have cash. You're always going to have accounts receivable. You're always going to have inventory, property, plant, and equipment. You're always going to have balances in those accounts, regardless of what happens in business. Same with liabilities. You're always going to have accounts payable. You're always going to have wages payable, taxes payable. You're always going to have, other liabilities, long-term liabilities. And then you're always going to have equity. The owner's contributions are always going to be there. The owner's the withdrawals are temporary, but the contributions are always going to be there. Their total is going to always be updated based off of what happens. Okay. So that's just kind of the rundown. So as I had mentioned, in order to close out these temporary accounts, we make the entries. So in order to close out balances in our revenue accounts, we debit income summary. We debit revenue, credit income summary. To close out the expenses, we debit income summary and credit all of our expenses. And we close out income summary to our net income, which goes into our owner's capital, right? The equity. Minus withdrawals, and that gives us our total. This is a visual representation of those steps. So step one, we close out our income statement balances. To close out our expenses, we are going to take our total expenses. We are going to then debit income summary and credit that balance. And for our revenue. For the revenue, we're going to debit the revenue and credit income summary. And as you can see, once I've debited my revenue and credited my income summary, and then I credited all of my expense accounts and debited income summary, I'm left over with a balance. That balance is representative of net income. That net income balance goes on to the balance sheet as owner's equity, right? So it gets transferred to owner's equity, minus any withdrawals, or the withdrawal balance gives us our balance of owner's equity. See how that works? Any questions on how to close temporary accounts? Hopefully I made that as clear as I possibly could. The visual helps. Questions on this so far? We okay? I didn't put anyone to sleep yet, right?
No, I don't want to ask questions
Okay.
about it because we have to do a side session. So
I got you. No worries. Yeah, it's all good, Tanika. I got you there. All right, cool. Great. So that's the closing entry process. Once we've gone through the closing entry process, then we prepare what's called the post-closing trial balance. What this essentially does is it helps us to make sure that our debit and credit balance is equal and that we didn't make any errors along the way. That's the idea here. After we close out all of our temporary accounts, this kind of verifies that we closed our temporary accounts the correct way. So, and this is what it looks like once we've closed everything out correctly. We can see that our asset accounts, cash, accounts receivable, supplies, prepaid insurance, equipment, and accumulated depreciation, those asset accounts are equivalent to our liabilities and equity. Liabilities are accounts payable, salaries payable, unearned revenue, and our equity account is our paid-in capital. And we can see the total debit, 43,045 balances in both the debit and credit side. Once you see that, you know you've done your closing entries correctly. And I see your hand. Nario, please.
Question. So you mentioned that the accounts receivable and supplies debt are the same, and that's how you determine if you're closing the account correctly.
I'm sorry, can you say that one more time?
What are the two things that you mentioned that you look at and tell that you close the account successfully? 'Cause I'm
Right.
kind of confused on that.
Yeah, no problem. I'm glad. Thank you for the question. So on the post-closing trial balance, the thing I look for to make sure that it's been closed out correctly is that the debit total and credit total are the same. So 43,045 is the same in both the debit and credit side. If they're not the same, then something went wrong. We didn't close out one of the temporary accounts correctly. And so essentially, we make sure that our assets equal our liabilities plus equity. So our assets are cash, accounts receivable, supplies, prepaid insurance, equipment, and accumulated depreciation. That total of those accounts equal the total liability and equities. In other words, it's the accounting equation, right? The accounting equation is assets equals liabilities plus equity. My total assets, cash, accounts receivable, supplies, prepaid insurance, equipment, and accumulated depreciation, equal the total accounts payable, salaries payable, unearned consulting revenue, and capital together. And that's how we get to the 43,045 total. And we make sure that our total debits equal our total credits in order to make sure that we successfully closed all of our temporary accounts. Denario, does that help to answer or at least clarify the question for you?
Yes, it does. Thank you.
Awesome. You're very welcome. Thank you for asking it. Great. So we go through the post-closing trial balance, and then once that's done, you've successfully completed the accounting cycle. So I want you to take a quick look at this nice, we'll call it a flow chart. And I want you to look at these 9 steps. The first step was to analyze our transactions. For those of you who remember our first day together, that was a while ago, right? Our first day together was middle of August, and it was on a Thursday. And we talked about, this was chapter 1, we talked about how to analyze the transactions. Remember, we went through like, I forget how many. It was like 14 transactions or something like that, right? And it was boom, boom. It was like rapid fire. We went through the 14 transactions day 1. And so the first thing we did is we analyzed the transactions and the effect it had on the accounting equation, assets equals liabilities plus equity. So that was step 1. The second step we did on the same night, which is to journalize those transactions, the debit and the credit, right? So what account got debited, what account got credited, that we journalize it. We do the journal entry, step 2. Step 3, also that we did during the first week, was to post the transaction to the ledger accounts, the general ledger accounts, the T accounts. So steps 1, 2, and 3 we did back in chapter 1. Then we went to chapter 2 and we prepared the unadjusted trial balance. I think, it was chapter 2. We prepared the unadjusted trial balance, and then I think we started to do some adjusting entries chapter 2. Then chapter 3, we did adjusting entries, adjust and post accounts. We also did chapter 3. We started to prepare the adjusted trial balance. Now, chapter 4, we did the prepare adjusted trial balance, step 6. We prepared the financial statements. Then we did the closing of the accounts, the temporary accounts. And the last thing that we just talked about was the prepare the post-closing trial balance. So over the past, well, I guess we're in the 4th week now. Over the 4 weeks, we went through the accounting cycle together. And that gives you an idea of how we did it. We go through this accounting cycle every single month. We do this every month, which tells you why accountants are always busy, right? But I mean, the reality is we have technology that does a lot of this for us, like QuickBooks or, one of the other accounting softwares out there does this for you. Okay. So you don't have to worry about the manual process of doing this. The reason why I have you learn this is because you need to understand how the accounting systems work. When you're a manager or a business owner or someone in a decision-making capacity for a business, you need to know how the accounting cycle works from a physical perspective. Because if there's ever like an anomaly or a problem that you need to solve, you need to know where to look. So that's why we go through the process. So every month we go through this accounting cycle, and it helps us to prepare our financial statements. So based off of the accounting cycle, we prepare our what we call a classified balance sheet. This is just the balance sheet. The difference is we classify it based off of its categories. You know that assets on our balance sheet include things like cash, accounts receivable, inventory, prepaid insurance. Maybe it might have notes receivable or some, things a little bit more long-term. And it's probably going to have property, plant, and equipment, which we know is our plant assets. It might even have intangible assets. These are things like copyright or, trademark or whatever, or goodwill. And then on the liabilities and equity side, for liabilities, we have accounts payable, wages payable, unearned revenue, notes payable, long-term notes payable, etc. Right? That's your liabilities. And then we have equity, owner's equity, right? So you know that the balance sheet has all of those things. But what we oftentimes do in accounting is we need to classify them as either being current or non-current, also known as long-term. Current assets and liabilities are assets and liabilities that I expect to utilize within 12 months or less. 12 months or less in accounting is called current. Current is 12 months or less. So the reason why cash, accounts receivable, inventory, and prepaid insurance, those are current assets. Why are they current? Because I expect to utilize them within 12 months or less. Long-term assets or non-current assets would include things like long-term investments, property, plant, and equipment, and intangible assets. They're long-term. I expect to use them greater than 1 year. They're non-current. They're long-term. I expect to use them greater than 1 year. On the liability and equity side, current liabilities, accounts payable, wages payable, unearned revenue. these are accounts that I expect to pay within 12 months or less. I certainly hope so. But I'm going to pay them in 12 months or less, right? Accounts payable, wages payable, unearned revenue. 12 months or less. Non-current liabilities, these are your long-term notes payable, mortgage payable, car loan payable. Something greater than 12 months, you see? It's non-current when it's greater than 12 months. Now we have equity, owner's equity. But that's what we call a classified balance sheet. And here's an example of that classified balance sheet. You can see how it's all broken out. Current assets, I expect to use in less than 12 months. Long term, longer than 12 months. Okay. Property, plant, equipment, etc. Liability side, current liabilities, I need to pay those in 12 months or less. Long-term liabilities, I'm going to take longer than 12 months to pay on them. You see? And then, but this is what we call, that's why we call it classified. We classify our accounts as either short-term, current, or long-term, non-current. You see? So again, current assets, I expect to utilize them within 12 months or less. Cash, short-term investments, accounts receivable, short-term notes receivable, inventory, prepaid expenses. These are all things I expect to utilize in 12 months or less. Makes sense, right? Long-term investments. These are things that held for greater than 1 year. An example of this could be a bond or investment stocks. Yeah. I'm holding on to these things for greater than 1 year. Why do businesses invest in bonds and stocks? You might wonder, right? It's very common for companies to invest in other companies by purchasing shares of stock from that company. The reason why a company does that is because they're collecting interest, right? They're collecting interest over time. So that's why they hang on to it for greater than 1 year. Same with bonds. A company might invest in a government bond of sorts, like infrastructure bond or something like that. Okay, and it's going to be greater than 1 year. Why does a company do this? To earn that interest. And greater than 1 year, long term. Plant assets, this is property, plant, and equipment. They help us to generate revenue, as you know. Intangible assets, these are things like patents, trademarks, copyrights, franchises, and goodwill. You might be wondering, what is goodwill? This might be the first time you've heard this term, other than going to the store goodwill. This is a different kind of goodwill. This goodwill is when a company acquires another company and there is a difference in the valuation. Okay, for example, Pfizer, the drug company, oftentimes acquires smaller drug manufacturers, and they'll pay more than the company is worth. Why? Because they don't like competition. I don't know what to say. But that's just one example, right? Why do they pay more than they're worth, you might wonder? In order to eliminate the competition, right? So the difference between the actual value of the company that they acquired and the amount that they overpaid, we call that goodwill. That's where the name comes from. It's goodwill. It's in good faith. So that's intangible asset. Current liabilities, these are liabilities I expect to pay within 1 year or less. Accounts payable, wages payable, taxes payable, interest payable. And I expect to collect my unearned revenue in less than 1 year, hopefully. Long-term liabilities, payments on greater than 1 year, mortgage payable, notes payable, bonds payable, lease obligations of greater than 1 year. A long time ago, I gave the example of UDC and their leases on copying machines are oftentimes greater than 1 year. In our case, they're usually 3 to 5 years. It's a long-term obligation. And of course, last one is equity. It's what the owners own, right? Paid in capital minus owners' withdrawals, net income, equity. Okay. Now, it wouldn't be an accounting class if I didn't at least have a couple ratios, right? In business, it is real easy to understand the financial health of a company. And we do that in a couple of different ways. We look at things like ratios. We look at things like horizontal and vertical analysis. You'll learn about that stuff in Principles 2. And we also look at what we call the building blocks. But primarily ratios. And why do we use ratios in business? Is because as a business owner or a manager or an investor or somebody who's interested, it's really easy to compute a ratio and understand the financial health of the company and the direction the company's heading in. So that's why ratios are important. My favorite ratio to compute is called the current ratio. Let me explain to you why it's my favorite. The reason why the current ratio is my favorite ratio is because it very quickly tells me if the company has the ability to pay its current liabilities. Does the company have enough assets to pay their current debt? Okay, that's what it tells me. It's got to be greater than 1. Anything greater than 1, you're in good shape. Okay, you can cover your current bills. That's good news. Okay, do you got enough coming in to cover your current bills? I compute the current ratio. And the way I do that is I take the current assets of the company, divide it by the current liabilities. If the ratio is 1 or greater, we're in good shape. That means we got enough assets to cover the current debt. Enough current assets to cover the current debt. That's why I love the current ratio. It tells me real quick if a company's in trouble or not. Okay? Take a look at these figures here on this slide toward the bottom. Here we were comparing Costco to Walmart. Costco's current ratio from the current year, this was actually like 2 or 3 years ago, is just over 1, 1.01. That's good. That's a good thing. Remember, 1 above, real good. Take a look at Walmart. Current ratio, 0.8. Ooh, Walmart in trouble? Okay. Very true. These are actual numbers, by the way. You'll be surprised to know that larger companies like Walmart and Target, they're struggling. Why are they struggling? You might wonder. Like, well, there's no way they could be struggling. They're like the largest retailers, right? Why are they struggling? The reality is because they don't turn their accounts payable fast enough. And they also don't turn their accounts receivable fast enough. And a lot of it has to do with their size. So are they actually in trouble? No, probably not. Would I invest in a company that has a current ratio of 0.8? Probably not. I'm just saying. I only go with ones with 1 or above. But I'm pointing out the reason why ratios are important and why my favorite ratio is the current ratio. And the last thing I want to talk about for today is this thing called reversing entries. Accountants are not perfect. I never claimed to be perfect. Okay, I never did. I was never perfect at my job. ever. In fact, I would make mistakes once in a while. Whoops. Or if I didn't make a mistake, maybe I recognized the mistake and I made the correction. Okay? It happens. Or maybe I had an employee that left the company and I needed to reverse some accrued payroll. I did the payroll in advance, employee quit, I need to make an adjustment. Rather than making an adjusting entry, I'm going to make a reversing entry. Reversing entries are totally optional, not a part of the accounting cycle, but they're really used when we make mistakes. Okay? And they're really simple. The idea is I'm simply reversing the entry. I make the entry, I debit my salaries expense, credit my salaries payable. The employee then quits on me. So I make a reversing entry and then make the adjustment. Reversing entry is exactly as the name implies. I reversed it. So here I made the mistake. I debited salaries expense, credited salaries payable. Employee quits or something happened. I need to make an reversing entry. So I debit salaries payable, credit salaries expense. I'm just reversing it out. That's all that's happening here. You see? It's a way for me to rectify a mistake or an error that was made without messing up any of your books. So that's why sometimes you might need to make a reversing entry. They're rare. They don't happen all that often. But when they do, you make a reversing entry, don't make an adjusting entry. So that's my talk. Real simple, right? So that's the accounting cycle in a very general sense. Remember, the accounting cycle, we covered this over the past 4 weeks. We started in week 1 with, identifying transactions, making the journal entry, and posting to the ledger accounts. The second week, we went through unadjusted trial balance, kind of went through that whole process. The third week, we did adjusting entries, pre and post closing trial balances. And then today, we went through, I showed you how to do the closing entries, and how to do the worksheet and do the post-closing, and then create the financial statements. And then we continued forward, right? So that's the accounting cycle in a very general sense. It's those 9 steps. We do that every single month. So what this chapter does is it helps us to connect everything we learned over the past 3 weeks. And so, any questions on the accounting cycle? Good. Okay. Right. I'm just, I gotta make sure you're all good. It's really important to me that you understand this stuff. What do we have to do for this week? As I had mentioned earlier, when we started the lecture, we have the LinkedIn Learning Certificate. It's going to take you probably about an hour and a half, maybe 2 hours. I very strongly recommend that you do this on class time on Thursday. So on Thursday at 5:30, I'd love for you to get into the classroom and knock out this LinkedIn Learning Certificate on financial accounting. You're going to like this particular one, and the reason why is because it covers pretty much everything that we talked about over the past 4 weeks. And it really helps you to also be forward-looking for this class. It's going to also go into stuff that we're going to cover probably next week. So you're really going to like this LinkedIn Learning Certificate a lot. I'm pretty sure of it. So let's try to do that on Thursday. That'll be really helpful for you, because that way you're not scrambling on on Sunday, right? And then definitely by Sunday, I need you to complete that chapter 4 quiz related to today's lecture. Are there any last comments, questions, or concerns? Anything at all? Anything at all? Good? Right. Well, as always, if you ever need anything, you can email me, call me, you can set up office hours. I know that, the last chapter was not that easy. So, and some of the questions may be a little tricky at times. So, yeah, set up some office hours with me. Or if the office hour times don't work for you, send me an email. We'll set up a time to meet. Okay. And we'll do a little one-on-one. No problem. No problem at all. Or if you think it's something is like, I didn't think about this or whatever, I'll help you out, whatever it is, okay? So you can email me, call me, set up office hours. I'm always here for you, okay?
Dr. B,
Yes, Joy.
do you have, because I know I met with you about chapter 3, do you have like any additional maybe practice, or like a recommendation to practice additional, um,
Yeah.
related to that,
Yeah. I'm
like
glad that
with
you
the
asked.
quiz?
Um, I probably, yeah, well, I do have, back in week 3, especially in that area, because I know that it's not the easiest thing in the world. If you go under instruction materials back in week 3,
Okay.
I do have some of this that I helped to draw out. I created this some time ago, but it really does this little additional reading information here that I created
Okay.
is relatively helpful. I also have this uh, what the hell is this called? This little image. But in addition to that, and I don't know if you had an opportunity to watch the LinkedIn videos as well, but I found those to be helpful. Under the Engage and Explore area, that we do have those Excel exercises. And if you haven't taken a look at those already, I would recommend downloading those.
I actually did do those.
Oh, you did? Okay,
Yeah, I did do those, and I actually like did good on those.
good, good.
I'm just gonna keep practicing because, like I said, just
Sure.
doing the whole like the relating the debits to the credits. I think I'm still trying to wrap my head around that.
Yeah,
But
and that's,
yeah,
I'm glad that you brought that up, Joy, because I know that some of your classmates are also kind of having some trouble, especially when it comes to understanding the different areas of where those accounts belong to, right? So
yeah,
what I recommended to Joy, and I would recommend it to the rest of the classes, and if you recall, back in weeks 1 and 2, during the lecture, there's a couple of slides that I thought were really helpful. One of those is back in chapter 1. And if you go to the chapter 1 and you come down to, it's like in the middle of the presentation, if you come down to the accounting equation, this slide right here, I like a lot. Assets equals liabilities plus equity, and then below there is the expanded equation. The reason why I like this particular slide a lot is because understanding that where each of the accounts belong will certainly help you when it comes to making something like an adjusting entry. I recommend that you print this particular slide out and put it up on the wall near your computer, or make sure it's written down somewhere where you can quickly reference it, because it's the foundation of everything we do in accounting. And so knowing that will certainly help when it comes to something like adjusting entries. The other thing I would recommend doing is just kind of reviewing these transactions. But if you go to chapter 2, in week 2, the other slide that I recommend that you look at, chapter 2, week 2, is going to be down here. And it has to do with, well, this one's good too. This kind of shows you what are the accounts and where they belong, assets, liabilities, and equity. But the other one I like is going to be, let me see if I can find it. Right here. Double entry accounting. Particularly this one, the expanded equation. The reason why this slide in chapter 2, week 2 is really important, and I recommend you print this slide out and put it on that wall or put it in your notebook or whatever, have it ready, is because it shows you where the normal balances are. For example, to increase an asset, we debit the asset. To reduce an asset, we credit it. When it flips to the other side of the equal sign, it's the opposite, right? So to increase a liability, we credit the liability. And to reduce it, we debit it. And then you'll notice with equity, it's a little bit more complex than that. And the reason for that is because, again, of that counting equation to get to net income. Right? We take the withdrawals, the capital minus withdrawals, plus revenue minus expenses. Now, every time we flip that sign, we also need to flip the normal balance. So that's why this particular slide is also going to be extremely helpful for you as we move forward. So if you think about those two slides moving forward, I think that they will help you to establish the foundation of everything in accounting. And it's really as simple as that. And then when you get to chapter 3, when we talked about the adjusting entries, chapter 3, we take that same concept and apply it. So when I get down to my adjustments, when I'm adjusting, when I'm making an adjusting transaction, the reason why I make an adjusting transaction is because I need to recognize the consumption of something. Think about insurance. I prepaid insurance for 24 months. I did it December 1. The year ends December 31. So according to the matching principle, I need to recognize the consumption of one of those 24 months at the end of December. So I'll take the total amount divided by 24 months and multiply by the number of months consumed for each year. Year 1, I consumed 1 month. Year 2, I consumed a full 12 months. Year 3, I consumed 11 months? So you see what I'm saying. We debit insurance expense, credit prepaid insurance. That's the adjusting entry. I do that at the end of each month, technically. I'm recognizing the consumption of that asset or liability or whatever it is. But that's how it's all connected. And hopefully you find that helpful. Thank you.
Thank you, Dr. B.
Thank you for bringing that up. I appreciate that, definitely. Right. Any other comments, questions, or concerns? Okay. Thank you all so much for your time today. Sincerely appreciate all of you, and I hope you have a wonderful rest of your night. Thank you so much. Tanika, we'll be in touch, right?
Yes. Can you confirm your hours for me?
Yeah, let me take a look at what those are.
It's on the syllabus, right?
Yeah, it's actually right here. So if you go under the start here and select office hours. So start here in office hours in the classroom, and you can book date and time. So you can just like, for example, like tomorrow, for example, I'm available these times.
Okay.
Friday, I'm available these times. So forth and so on.
Okay, cool.
Okay. And if for whatever reason you can't make those times, just shoot me an email and say, hey, can you, how about this day at this time? And I'll see if I can do it.
Okay.
All right.
Thank you.
You're very welcome. My pleasure. Great. Well, thank you all so much for your time today. I sincerely appreciate all of you, and I hope you enjoy the rest of your night. Thank you so much. Take care.
Thank you, Dr. B. Good night.
Thank you. Good night. Bye-bye.
You too.
Take care. Bye-bye.